In some ways, it's never been easier to invest in AI, with every public company jumping at the opportunity to overhaul its business in the face of the new technology. And on the other hand, given how much of the stock market is reacting to AI news, it's becoming a whole lot harder to beat the market with a novel AI trade, I should say. That is a phenomenon that Ken Brown, our finance editor, wrote about in his weekly finance column out today, and I want to bring him on to tell us more about his piece. Ken, welcome back to the show. It's great to have you here.
Hi, Akash.
So, what made you want to write this column on this day, the first week of the year, as people are looking ahead to their investment portfolios? I mean, this is not something we typically write about. The information.
Right. So there's two reasons. One is this is going to be a year where we're going to probably see some AI IPOs. There's talk that Anthropic will go public this year and OpenAI will follow maybe next year. And investors are eager to get into this stuff. The other thing is I got a question from a relative of mine, a couple relatives, because I deal with AI all the time and I deal with money and how should we invest in AI? And so I did a little research and looked at what was out there and decided, the timing was right to write a column.
Okay. So the column was great at diving into some of the more creative ways that people are, or that companies rather, are offering exposure to,
Right.
and by companies I should say, companies whose business it is finding retail investors ways for them to make money. Talk a little bit about some of the deals that we've seen in the market and how that's shaped up.
Yeah. So, most of these big AI companies are still private, right? I mean, there are public ones like Google and all that, but the pure plays, the startups are private. And so both Schwab and Robinhood and other brokers are trying to figure out ways to help investors get into these private companies. And, my research shows it's generally not a very good idea for individuals to do this. The fees are high, they get in at the wrong time, the prices are high. And the reality is they're kind of last in line to get this stuff. I mean, all the big, powerful investors, the VCs, the private equity firms, the sovereign wealth funds, they're all in there first. And so, us little guys, we are not a priority and we don't get the best deals. And so I just wanted to, if people got excited about it, I wanted to sort of at least sober them up a little.
And just to be clear, this is individual investors finding ways to get exposure to these private companies through these newer platforms, I guess, that have become more popular. That's sort of where your caution is coming into play here.
Well, so my caution is two things. So one is, yes, there is a push for by brokers, and investors are asking for it to get access to these companies, Anthropic, OpenAI, all that stuff. I want to invest in AI. I want to get into this stuff. How do I do it? And so that's happening. The other thing is people are making bets in all kinds of novel ways on the stock market with the companies that exist publicly and other ways that they feel like they can get AI exposure. I also warn people about that. I mean, so this is a little bit of a personal finance column because
It's a
we don't
finance call. It's just a finance call, Ken. It can be
just a
whatever you
finance
want.
column, and we don't tend to do that, but it is a confluence of events, and so the track record of these kind of funds that people are buying now is terrible. The funds perform badly. Uh, they can do great for a while, and then when everyone puts the money into it, they they do terribly. A lot of them shut down. Most of them trail the market. I mean, when you look at the data, like 80% of them shut down or lag the market after 3 years. And so I just want people to be aware that this is exciting. We spend all day writing and talking about it, but for an individual investor to get into it, you just got to be smart about it and careful. The other problem is everyone owns this stuff already. Google, Microsoft, Meta, all these companies are public. They
Right.
make up around 25 to 30% of the stock market. So everyone's exposed to this. So why do you need any more?
Wow. Because more is more, Ken. I mean, that's the whole
It's
point.
no, exactly. And it's a very exciting area. And there's going to be monster companies and lots of money to be made. And so, as I end the column, I say, I've given all this advice. And next year, everyone's going to come back to me and say, we made all this money ignoring your advice. And so,
Right. Yeah, yeah, that's typically how holiday dinners end up going.
yeah, yeah, yeah. And so, you two can come back to me and
No, no, no. Look, well, I don't invest in any of this stuff. We just write. That's all we do.
exactly, exactly.
um, but I do want to talk to you about another pocket that you touched on briefly, which is the energy sector.
Yeah.
And the energy sector is another area that people have been talking about as an opportunity. But then as I thought about that more and I read your column, then I got to thinking again, like if you just buy the S&P, I mean, the energy companies are all moving according to these deals anyway.
Right, and so the beauty of index funds, which is what a lot of people own, is you get exposure to everything, and so you never miss a big run up in something, which is fantastic. Yeah, I know the energy companies. I mean, and it's a volatile sector, and people are pouring a lot of money into AI. But people with longer memories longer than a year, remember that the hottest energy trade 2 years ago was the energy transition to solar and wind and batteries and all that stuff. And that trade has turned out to be a terrible trade for investors. They lost a bunch of money. And so now people are thinking energy to power AI. And it's true, it could be really interesting, but it is a volatile sector. And the track record in the past is, it just ain't great.
Right. Let me ask you one more question. As we talked about investing or finding exposure to private companies,
Mhm.
I couldn't help but think about the notion that companies go public when they're ready to go public
Right.
in the sense that they have some sort of predictability about what their cash flows, what
Mm,
their revenue growth will look like. I mean, it struck me as another point of caution here that if a company is private, I mean, yes, there is all of the financial reasons why maybe they haven't had to raise all the money, but
mhm.
there also might be sort of this reality that the company says, dude, like I'm not ready to be a public company. We don't want retail investors yet. I wonder if you think that that's another consideration to this.
Well, and I mean, that's been true. A bunch of companies like Stripe and a few others. SpaceX have stayed private a long time, longer than you would think, given their size and success. Yeah, and then who goes out? Who goes public? I mean, one question is like, do they desperately need the cash? Right? Have they exhausted every other way to raise cash in private markets, and so they're going public? And then yeah, like, do you want to be that person buying that company that's desperate for cash? And the growth rates are fantastic. But public investors in the stock market care about profits. Eventually, they care about profits, and we're not seeing that for a while. So, yeah, they're going to be really interesting. It's going to be a great story for us. I'm happy to be covering it, but I don't know if I want to invest in it.
Right. Well, Ken, I want to thank you for coming on. That is Ken Brown, our finance editor here at The Information.